Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world. What's going on, guys? It is Wednesday, June 11th, and today we have a hot Bitcoin summer, Solana ETFs coming in the fall, and a state banning Bitcoin? Before we get into all that, however, if you are enjoying The Breakdown, please go subscribe to it, give it a rating, give it a review, or if you want to dive deeper into the conversation, come join us on the Breakers Discord. You can find a link in the show notes or go to bit.ly/breakdownpod. Hello, friends. Where I am right now, it is in the 90s, but that is not nearly as hot as Bitcoin is looking right now. Yesterday saw a huge surge, touching 110,000 for the first time in 2 weeks. The drawdown around Elon's spat with the White House last week saw Bitcoin go all the way back down to 100K. But positive momentum is back, and many are canceling their beach trips to stay locked onto markets. Keyboard Monkey tweeted, "Good morning. GM, market blue sky summer ahead. Feels likely, no real negative catalysts or headwinds to note." Bitcoin Jack wrote, "These are the promised lands, lads. Enjoy before they hurt you again." Now, traditionally, summers have been a pretty boring time in crypto, but some feel that this time will be different. And if that kind of rapid sentiment shift feels a little toppy to you, then get a load of Michael Saylor. In an appearance on Bloomberg yesterday, the host asked him when this cycle would end in an inevitable collapse. Saylor gruffly responded, "Winter's not coming back. We're past that phase. If Bitcoin's not going to zero, it's going to $1 million. After listing off a dozen government and institutional figures now in favor of Bitcoin, he commented, "Bitcoin has gone through its riskiest period. The accounting has been corrected." Taking the opportunity to do some public moon math, he pointed out that only around 50 million of Bitcoin is produced per day, adding, "If that's bought, then the price has to move up to find any seller that's price sensitive." Saylor commented that the Bitcoin treasury companies are buying that amount every day, that the ETFs are buying that amount every day, and that's to say nothing of sovereign wealth funds coming in as well. Saylor said, "At the current price level, it only takes 50 million to turn the entire drive shaft of the crypto economy one turn. The writing is on the wall, Bitcoin's moving higher." Now, we all know that nothing bad has ever happened after a prominent crypto figure called for the end of bear markets. Saylor didn't say the word supercycle, but the sentiment was the same. And yet, it's hard to find a properly bearish case right now, at least in the short term. Leverage is building up in the Bitcoin treasury companies, but recent research from Galaxy Digital demonstrated it's not a big risk in the short term. Across all of the companies, there's just 67.5 million in debt to be rolled over this year, all the way out in December. 2027 has another $3 billion coming due, along with $7 billion in 2028. Finance lawyer Scott Johnson commented that the risks are, quote, grossly overblown. They'll saturate and no longer provide marginal demand at some point, but there's nothing to suggest they'll start hemorrhaging BTC. A more reasonable bearish case came from Bitfinex analysts, and that was simply the lack of a bullish catalyst. They wrote, "The risk of a short-term correction continues to build, especially in the absence of a strong catalyst to push Bitcoin decisively above the current all-time high. Without a strong macro or structural upside catalyst, Bitcoin is vulnerable to short-term corrections, particularly as long-term holders distribute into strength." Now, next week's Fed meeting is looking like a nothing burger. We've had just about all of the policy catalysts we're going to get, and it's difficult to think that the 70th MicroStrategy clone will move the needle. There's nothing obvious on the horizon that would push Bitcoin into a blue sky breakout. Still, derivatives positions suggest that the next big move will come from a gigantic liquidation. Joe Consorti of Thea Bitcoin wrote, "The battle lines have been drawn. A move of $1,000 in either direction sends Bitcoin back to the bottom of its range or up to try for a new all-time high. A Western movie standoff between the bad and the ugly. We'll see what happens. And from where I'm sitting, whichever way the next move falls, the year looks like we're set for a much hotter Bitcoin summer than normal." And what might come in the fall to follow that hot Bitcoin summer but a Solana autumn? The SEC has requested updated documents for the Solana ETFs, which previously has signaled an approval is on the horizon. Bloomberg's Eric Balkunas posted, "Get ready for a potential altcoin ETF summer with Solana likely leading the way, as well as some basket products." His colleague James Seyfarth has updated the odds for approval this year on each category. Baskets or crypto index funds are now listed at 90% likely to be approved, which were the same odds applied to Litecoin and Solana. Several other top 10 coins were given odds between 75 and 85%, including the Dogecoin ETFs, which I'm sure will be going straight into many retirement accounts around the country. Focusing on the Solana ETFs, which seem likely to be the first out of the gate, Seyfarth wrote, "We think the SEC may now focus on handling filings for Solana and staking ETFs earlier than planned. Issuers and industry participants likely have been working alongside the SEC and its crypto task force to hash out rules, but the final deadlines for the agency's decisions on such applications aren't until October. For the asset managers, crypto index products are one of the big bets. At a recent event, 21 Shares president Duncan Moore said, "Basket products are going to be more interesting. It's like you don't know which is going to be the winner, so you buy a basket of them all. It's a no-brainer. I think that's going to be a big trend." Nate Garassi of the ETF store is simply ready for everything to start happening, tweeting, "Looks like the SEC are about to open floodgates on crypto ETFs. Last step before all major brokerages offer direct spot crypto trading. Then we head down the path towards full securities tokenization. ETFs are the bridge between TradFi and DeFi. That bridge is nearly built. Crypto is going mainstream." Today's episode of The Breakdown is brought to you exclusively by Grayscale. Grayscale is almost certainly a name you know. They've been offering exposure to crypto for over a decade now and offer over 20 different crypto investment products ranging from single asset to diversified to thematic exposure to crypto and the broader crypto industry. They have long been innovators at the intersection of TradFi and crypto, and one of the benefits for a lot of us is that Grayscale products are available right through your existing brokerage or IRA. Now, of course, investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. Go to grayscale.com to explore their full suite of crypto investment products and invest in your share of the future. And yet, not everyone is getting excited about Bitcoin this summer. The Connecticut State Congress has in fact passed a Bitcoin ban. How very, very retro of them. State and local government bodies are now banned from investing in crypto or establishing a crypto reserve. The new law shouldn't affect individual holders, but it does tighten up risk disclosure requirements for exchanges. Largely, it seems to be a signaling device. After New Hampshire established a Bitcoin reserve last month, Connecticut seems to have decided that they need to form a bulwark against the spread of libertarian ideas. Status Sachs commented, "The entire population of Connecticut are New York fiat fund managers. They have no incentive to diversify into Bitcoin." Gotta say though, man, as someone who knows a lot of those New York fund managers, there is a heck of a lot of Bitcoin exposure over in Greenwich, let me tell you. Switching to Washington, the crypto bills continue to gain momentum. Yesterday saw the Clarity Act pass through the House Ag and Financial Services Committees. The market structure bill enjoyed near unanimous support in House Ag. It was approved by the committee in a 47-6 vote after a 3-hour markup session. The process in the Financial Services Committee was far less smooth. Debate raged late into the evening with anti-crypto Democrats squabbling over endless amendments. We did not get a big stunt out of Ranking Member Maxine Waters, but she did push for an amendment to address the president's crypto conflicts. Committee Chairman French Hill commented that this is, quote, "not an ethics bill, so in my judgment, it is not necessary to support the Waters amendment." Brad Sherman proposed an amendment to prohibit bailouts of the crypto industry in the future. He said, "The purpose of the Clarity Act is to build a superhighway to crypto becoming so significant that it poses a systemic risk, and then make sure that every Republican member of this committee can say they're against bailouts, but find an excuse not to prohibit bailouts." Chairman Hill wasn't sure which bill Sherman was reading, reminding the congressman that this legislation was, quote, "not about bailouts, it was about consistency." He added that the bill largely identifies, quote, "when a digital asset is considered a security under the oversight of the SEC, or a digital commodity under the authority of the CFTC. Neither Sherman nor Waters saw significant support for their amendments. After many hours of very pointless debate, the bill passed in a bipartisan vote of 32-19. The bill can now proceed to a full vote on the House floor before getting passed over to the Senate for another run through the committee process. Honestly, the takeaway is that crypto looks to have a pretty broad base of bipartisan support despite the very loud critics. During the session, Republican Brian Steele remarked, "Market structure legislation is not about Democrats and Republicans. It's about moving our country forward." Keeping tabs on stablecoin legislation, the Genius Act is set for another cloture vote in the Senate floor later today, so we'll have news on that result tomorrow. The bill was amended after last month's vote, so it will again require a 2/3 majority. Reporting suggests no major changes to the crypto elements, but a rider mandating competition on credit card fees will be added. Should it pass in the Senate, the House will still need to approve a companion bill before it can become law. Galaxy Digital's Alex Thorin wrote, "All told, we still think Congress is on pace to deliver a stablecoin bill to President Trump's desk before the August recess, though timing could be close and get stretched." Yesterday also saw nominated CFTC Chairman Brian Quintenz sit for his Senate confirmation hearing. Quintenz was formerly the head of global policy at A16Z Crypto, and his testimony reinforced the idea that he will be a pro-crypto agency chair. Quintenz stated, "It's time for a comprehensive regulatory framework for crypto assets, including token classification clarity and clear jurisdiction for trading market oversight. I'm fully prepared to use my experience and expertise to assist in that effort, as well as in executing any expanded mission should legislation pass into law." Quintenz commented that he met with global regulators during his time at A16Z, so he, quote, learned what they've attempted to do, what they've left to do, and what has worked well or poorly. With conviction, Quintenz said, blockchain and crypto tokens are here to stay and will allow individuals their own digital intellectual property, their digital identities, and the value of their contribution to networks. I view blockchain as a horizontal technology that has the potential to touch every aspect of society. Overall, the hearing was relatively uneventful. We got an interesting tidbit from Senator Tuberville that Quintenz had been debanked by UBS in 2023, along with basically everyone else in the industry. Quintenz was also questioned on the need for additional funding to add crypto to the jurisdiction of the CFTC, to which he commented, once rules come online, then there is new authority there is a new jurisdiction, and it's usually been a precedent to accord the agency new resources. Senators on both sides seem to agree, with Quintenz demonstrating that his CFTC will still have an active enforcement role. He pledged that his commission would focus on both risk and innovation, maintaining zero tolerance for bad actors. If approved by the Senate, Quintenz will have an opportunity to shape an entirely new commission. Each of the 4 remaining commissioners have resigned, so Quintenz and the administration will have the opportunity to pick basically the entire panel. And so, friends, that is the story from here. A lot continues to cook this summer despite the normally quiet period. I'm excited to see these policy actions continue to move forward, and it is never bad to see that 6-figure Bitcoin continue to surge. For now, that is going to do it for today's breakdown. I appreciate you listening as always, and until next time, peace.